Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Santa's Christmas carols continue for the markets, which has been on a hot streak. Yields falling, equities near all-time highs, dollar being sold across is the ongoing theme. Bonds have been getting good demand as investors try to lock in the yields before the anticipated Fed cuts. Good morning, JK. Your thoughts on the recent moves?
Good morning. Good morning, Swaraj. Into the last few sessions of trading for 2023, we had very little news to chew on, but a lot of market moves to digest. We saw a no-holds-barred rally in global bonds yesterday, major squeeze in the Indian equities, and of course, the dollar, which slipped through major supports with consumables. As risk assets reached dizzy heights, demand for safe haven treasuries have surged and investors piled freshly into the bonds across countries, supplies due to fresh actions by Fed being easily absorbed. It does appear FOMO has taken over even the bond market and led to further surge in prices, or rather fall in yields to new cycle lows. Twos at 4.23%, that's 7-month low, and tens at 3.78%, that's 5-month low, and 30s at 3.94, all saw decent declines yesterday. German 10-year at 2.89 broke the March 2023 lows, while the UK 10s at 3.45 has the widest gap with its official policy rate of 5.25%. Stocks had another positive day, though gains were smaller in comparison to previous sessions. What's evident is when you have few catalysts and minimal trading activity, players tend to see continuation of the trends, rather they like to be with the trend. The remaining two sessions, of course, can see more of the same. And year-end related activity could, of course, see a bit more of two-way intraday moves, but it does appears that the markets are going to end at their best levels as far as the stocks are concerned, and perhaps at the worst level for the dollar as well. We did have news from Bank of Japan that said it would reduce the sums in its regular bond buying operations in the Jan-March quarter. Not a significant move, but some subtle indications that they are on the path to a slow reversal of the easy money policy. But market reaction immediately was not much. But as the yields in US moved lower, the yen also moved higher along with other currencies, even trying to breach the support at 141. The yields making lower lows also pushed euro to its 5-month highs at 1.1125, and dollar index fell through 101, which was last seen in July 2023. Even as the market views Fed as more dovish than other central banks, dollar selling has got the momentum, though I think year-end conditions have exaggerated it. However, such actions by Fed can only come inflation falls much faster, because economy-wise, US is still doing much better than other major economies as well. On the data side, we had the second-tier data from US confirming the still slowing manufacturing activity, but services holding up. In fact, this has been the trend in major economies, with latest evidence coming from big slump in Japanese industrial production published today. One last interesting indicator today would be the weekly jobless claims that is expected to rise to 210,000 from 205,000. Indian rupee and Chinese yuan were clear laggards, more so with the rupee as it pushed towards all-time lows, even as the dollar index was breaking into years lows. The fall in INR is attributed to year-end flows, short covering on the day of monthly contract expiries in the F&O segment, and had little to do with any fundamentals, of course. Well, that's been the feature of INR moves for the last several months, which has only seen small jerks, that too when the central bank thought it fit to do so. Just for a perspective, in a month when we had big political positive news and record inflow of USD 9.4 billion, may well touch 10 billion in the next 2 days. Rupee mostly traded in 30 paisa range with a negative bias. Meanwhile, in yesterday's trading, rupee also hit a new all-time low of 92.60 against the euro. My view is that this tight range is a temporary phase and likely to see a breakout in the new year with the rupee's strengthening bias. One good news for overall inflation is the oil price edging again lower, posting the largest drop in 2 weeks on signs that US stockpiles build much more with more technical indicators being weak. But importantly, reports also indicate some shipping companies considering a return to Suez Canal route, even as the US-led task force made security arrangements for ships sailing through. So the WTI as well as the Brent fell more than 3% in yesterday's trading. So we have into the last day of trading, last 2 days of trading today and tomorrow, and expect more of the same, some more dollar weakness because players would like to keep with the trend. And interesting would be with the spot date moving into the new year for the USD-INR, whether we will see a larger move or whether we will see rupee strength. That is something we'll wait and see. Thank you.
Thank you, JK, and I will just use the line you mentioned in the beginning. Little news, but a lot of market moves. As we had been discussing, bonds continue to be bought, and yields have fallen to new cycle lows. Bonds have been bought across countries, and equities are looking like they're going to end the year at their best levels. Euro is at its 5-month high. But one thing to remember, of course, is what JK mentioned. Economy-wise, US continues to be better as compared to other major economies. And the key data to look out for today would be the US weekly jobless claims data. Indian rupee pushed towards all-time lows as the expiry of the monthly FNO contracts happened yesterday. And despite, and one good perspective that JK mentioned was that despite good political news this month and record inflows, we saw rupee trade in a narrow range and with a negative bias. That's it from us today. It's just one more day tomorrow before we end the trading session for this year. So do tune in tomorrow. That's it from us today. Thanks for listening and see you all tomorrow.